ladies and gentlemen, I have brought them back.
Yay!
Because they have more to teach us, and we always have lots to learn. So we have with us Ryan and Connie from First United Mortgage Group, two loan officers that are here to teach us about loans. And like I said in my video this morning, guys, the loans are becoming more and more important. It's in the 6-7% interest rate kind of world, and all of these new loan products are coming out. And having a firm understanding of the basics is going to really help you be able to utilize these things, because I'm going to say it before, I'm going to say it again. Half of y'all will not be here in 6 months. And unfortunately, the educated are going to be the ones who survive, because we're going to have to be able to make way with these times, because it is getting tricky out there, guys. It just flat out is. I know I'm having some difficulties moving houses, getting things done. So let's learn something. Connie, Ryan, ready, set, go.
So I think most everybody we met last time, but again, my name is Connie.
I'm Ryan Big.
And obviously we have a presentation, but I want this to be a lot more just like as we go and you have questions and thoughts and have conversations. That's a little bit more of the style that we have. So today we're going to talk about construction lending, right? And I will tell you, I am not expecting you to be a construction lending expert at the end of this. What I want is that you have a grasp on how a construction loan works so that you can set appropriate expectations and add value to clients while going through this process. Okay. So that's a lot of the approach that I'm going to take from this, and like the way that I'm going to teach this. I'm teaching you two from a real estate perspective. I'm not teaching you from a client perspective. Okay. So just know that's a little bit of the way that we're kind of tailoring this. So when we talk about a construction loan, right? A construction loan is a short-term, normally interest-only loan that's used to finance the build of a residential home. Not saying that there's not construction loans for commercial, but we're focusing on residential today, okay? And we learned this last time when we did the, I love how the dog is in the Zoom. Anyway, sorry. We learned this last time we had the Jeopardy game. Construction loans or portfolio loans. Everybody remember what that is? So that means that it is money that is lent from the bank, right? So when we are talking about this today, we are talking about First United rules. We are talking about First United products, right? We understand that there are other lenders that do stuff differently. We understand that there's other lenders that have different rules, right? We're not talking about your traditional loans that we kind of all live in the same box with. This is very specific to us, okay? So just kind of know that and keep that in mind, right? And don't be scared if we have a conversation and we're not the right fit for your client. It doesn't mean that the deal's dead. Just means that we may have to look for different options, okay? So when we're also talking about construction loans, remember, new construction does not always equal custom construction, right? We are talking about custom construction today, right? So new constructions, your D.R. Hortons, your Lennar's, your Perry's, your Sitterly's, like basically someone else carries the construction loan and your clients buy it at the end, right? If you work with investors that do spec lending, that still falls under new construction. We are talking about when a client buys a lot, they carry the interest-only construction loan and they carry the perm loan at the end, okay? So there is a difference. In general, I will tell you, in this market, you're going to get more bang for your buck buying a home than building a home, okay? In general, right? So that is something to just kind of remember is we're talking about custom construction and it's not the cheapest way to go on average, okay? Something to talk about before we kind of dive into construction loan is just because someone can qualify to purchase a home does not mean they qualify for a construction loan. I would say in general, our construction loan customers are a little stouter, right?
Yeah. They're gonna have to usually have money in the bank because there's a lot of unforeseen things that happen in custom construction where they may need their additional funds to complete a project, things like that. So
usually credit scores.
Yeah. It's just a little bit more risky of a loan.
Right. And does everybody understand when we say risky, like what we mean by that? Is let's say that we're building a house that you design and God forbid something happens to you. Now I am stuck as a bank with a half-built house that is was designed to someone's needs that I can't really get a loan on because it's half built, and now I have to try to sell this thing, right? So in our head, we have to be in a better position than if we just had a pre-existing house, because there's more risk inherently with that.
Like I'm dealing with a friend of mine right now that basically the builder took soft cost draws and took some hard cost draws and then ran off, and he's not in communication with that homeowner anymore.
And remember, and we'll talk a little bit about this too, but like when someone is building your house, they have a lien on your house, right? So if all of a sudden a builder runs off with your money, it's not just that they ran off with your money, they have a lien on your house that they have to release, where there's a lot of drama and hoops to jump through for that client, because title won't insure it, a bank won't lend on it, it gets very hairy. So the other thing I will encourage you is, when you have a client, you don't want to just go to any, we call them chucking a trucks, like chucking a truck that's like, oh, I can build your house, right? Like, you need to know them, you need to have seen projects, talk to people that have used them, because there are a lot of risk inherently, again, with not only the bank, but as your customer with a construction loan. Okay.
One of the biggest things that you want to check is how long they've been in business, because you know, if they have any kind of projects that they didn't finish, they'll have liens, judgments, things like that, and then they change their name and start a new company. So it's one of the most important things.
Okay. And again, we're not trying to scare you. We're just trying to help you set appropriate expectations, because you as a real estate agent could be the difference between someone getting in a bad spot and not. Okay. All right. So let's dive into types of construction loans. Okay. There's two types of construction loans. I'm gonna generalize this a little bit, but in general, there's two types of construction loans in the world. Okay. One is a one-time close and one is a two-time close. And I will tell you, there is validity in both. Okay. There are reasons that we would do one versus the other. And most people have been trained to say, oh, this one's better than this one, or this one's better than this one, blah, blah, blah. And I will tell you, that is a conversation that us as a lender needs to have with a client once we have seen their application and figured out what they're doing. Okay. So just know that you as a real estate agent needs to understand what the difference is. So if they're asking you questions, but don't steer them one way or the other, because that's what we're for. Okay. I want you to understand how they work, but I also don't expect you to be like, well, you need to ask for a one-time close versus a two, or so on and so forth. Okay. So let's talk about a one-time close. These were really, really popular in 20 and 21 when rates were 3%, right? I'm going to go build a house. I'm going to lock an interest rate and peace out, Boy Scout. That's what I have for the rest of my loan, right? I will say they've become a lot less popular now, right? Again, they serve a purpose, and we're going to talk about that. But in general, the average consumer, rightly so, wanted these when rates were low.
And so the main difference is, on a one-time close, you lock it dirt, you lock your rate for the whole loan, and it basically converts, or something at the end, to your permanent financing. But two-time, you close on the initial interim loan, which is that 12 to 18 month interest only. And then at the very end, about 45 days out from completion of the house, is where you work on your permanent financing.
Okay. On a one-time close, you can truly close once. I can do a lot purchase, a construction loan, and permanent financing all at one time. Okay. So I can truly close a loan one time. Now, what I will tell you, and what a lot of people don't realize, is if you're doing the lot purchase, usually you're either buying from family or you're buying from the builder, because I have to and I say I is like teen construction lenders, right? We have to have the plan of what you're building, what the cost is, and how you're building it before I can ever go to underwriting and processing and ordering an appraisal, right? Because regardless of what construction loan you do, I am doing an appraisal based on what's going to be there.
As completed value of the home.
Right.
And they're a little bit more in depth, because you got to remember that they're looking at plans, they're looking at a budget. And so when you're going and looking at the comps, you're going to have to figure out what's going to be in that home, visualize it, and then compare it to what the other homes have actually sold for.
So which value do they use? Do they use the comparable sales value, or do they use the rebuild cost, because it would be the most accurate.
No, comparable sales.
Comparables.
Yeah, the only really thing that we tend to use the rebuild is for insurance purposes, typically.
Because insurance works a little bit different on a construction loan as well. Okay.
Builder's risk.
Builder's risk
Yeah.
and general liability. But yeah, these are, I will say, one-time closes with us are actually really unique because if it's a conforming loan, which remember was 766, 550 or lower, if I close on this now and rates have fallen by the time the house is done, they get to do something called a modification, which is a very cheap refinance into a secondary market product, right? So on conforming loans, there are still times that I'm taking people one-time close. It's also really good if you have someone with super unsteady income, right? Like I have a guy that's made a ton of commission. Like let's think of a new home sales guy, right? Let's say he's made a ton of commission 21 and 22, 23 and 24 are going to be trash, right? I'm probably going to take them one-time close because I want to make sure they qualify even when the house is done, right? But if I have someone that's a little bit more steady income or something along those lines, I have some more flexibility. If you have someone that tells you they're going to retire or wife is pregnant, going to quit a job, stuff like that, those are things that we need to know because I'm probably going to put them in a one-time close because it protects them, right? In the grand scheme of things, paying a little extra in closing cost or paying a little extra on an interest rate is better than getting in to where you can't qualify for your house the second time.
It's a house you can't pay
Right,
for.
right.
Yeah, because there's only so long that bank's going to renew and extend that interim loan because they're really supposed to be short term, and there's a lot of cost involved with that and things like that. And so you could technically be in a position where you can't get to a permanent loan and lose your home.
That or you're paying interest only for 3 years, and that's a giant waste of money. Like stupid. So anyway, a two-time close is basically a construction only loan. Okay. We will give everybody 12 months. If you're over 750, we give you one extension. And if you're over $1 million, we give you 2 extensions.
For years?
Hmm?
For a year?
No,
6 months and 6 months. So 2 years would be our 20, like, 24 month or.
Yeah.
And I want to back up because we keep talking about this, but everybody understand how interest only payments work? It is like a credit card. So just because let's say I have a $600,000 loan, you're not paying interest on $600,000 because you haven't borrowed $600,000. You're paying interest on the amount of money the builder has used, right? And a lot of clients have a hard time grasping that, right? And so that's a conversation that you should be having with a borrower if they're looking at a lot and they're talking to you about potentially a construction loan, which we're going to talk about other expectations to set in a second. But you need to tell them like you are going to be paying 2 payments, but that payment's going to grow, right? It may start out at $400, may end at $3,400, but you're not going to be paying for the full amount
The whole time.
the whole time.
Yeah, so you make a draw for, let's say, foundation costs you $100,000. That following month you're paying interest only in the $100,000. Then you need another $200,000 for framing. So then you're paying interest only on that $300,000. So they start out small and progressively get larger throughout the build.
Yep. Two-time closes are really popular for VAs because I have on both of my products, I only require 5% down up to a conforming loan amount. Jumbos are a little different ball game. But basically what we do is we do 5% down and we would refi you into VA on the back end, right? In general, I would say most of your construction loans are conventionals, right? Not always, but most, right? They're serviced by the bank, they're a conventional loan. So even if I have a VA client, I'm going to do a conventional construction loan and then I'm going to refi into a VA.
And so VA just guarantees that the lender, it guarantees a portion of the loan so the lender does not take a loss. They've never actually fund their own money into transactions. So that's why you don't see a lot of VA construction loans.
Does everybody understand that? What we mean by that? So like Fannie and Freddie actually gives us money when we originate a loan, a conventional loan. VA says you're not going to lose your tail on it. We guarantee it. So it's a little bit of a different ball game between the two. But what we're saying is the VA doesn't actually give money for the loans; they just back them up. So you don't see it very often where the VA is giving money to build a product. Okay. And there are lenders that do 100% VA construction loans. I don't like them. I don't think it's a good idea. I think you need to have clients that have some cash, to have some skin in the game. But they exist. We just don't do them. Okay. The other thing, and why I do a lot of 2-time closes, is because a lot of people don't want to sell their house and live in an apartment, right? And so what I'll do is I'll do a primary, or like a construction loan at a higher amount. You sell your house and I refinance your second loan at a much lower amount. And that way you can inject those funds at that time. Okay.
There's some flexibility with debt to income ratios with a 2-time close if you're planning on living in your property. And so it gives you a chance to build your house, do the whole construction process and then sell your home at the end, or rent it out, or, it gives you a little bit more flexibility to allow you to stay in your current property.
Mm-hmm. Right. And in the grand scheme of things too, and this is going to be 2-time closes with me, that's going to be 2-time closes with a broker down the street. You can shop for your perm loan. Like for us, we're actually going to give them a portion of their origination fee back to incentivize staying with us. But let's say that you hated us and you wanted it to go fall off a cliff. You can take your loan somewhere else once it's done, right? That's not going to be how the process goes. You're going to love us. But we tell people that we're not trapping you into this, right? There's nothing that says that you can't shop it on the back end, right? So know that. What a lot of other people don't know, and why I take a lot of people 2-time right now, is because when you refinance on the back end of a construction loan, you have discounted fees. Like specifically your title policy fee is a lot cheaper, because remember, in a purchase, we usually have a seller paying a lender's title policy, right? And lender's title policy insures you up to the loan amount. Well, guess what? In a construction loan, there's not a seller, right? So my buyers, right, my borrowers are the ones that are now paying for that. So on a traditional refinance, you have to pay lender's title insurance, and you pay lender's title insurance again. And obviously it's discounted. Y'all are good. Come on in. Discounted, but when we do a construction loan, it's a very discounted fee. Like it's like usually about a $329 fee, because what they do is they basically do a lien search and they just reissue title policy. It's not a full-on title cert. And so we may save the client $3 or $4 grand. And being that we're in an environment that rates are projected to go down, why am I going to lock them at this higher rate where they have to pay a whole nother set of refinance stuff?
Because you ran a full title search when you got the land.
That's right.
Perfect.
And that took it all the way back to the sovereignty. Just make sure nobody owes anybody.
Yeah.
Right.
What they do is actually it's a title binder at the end on a 2-time, and so the state sets that cost, and so it's only $328.
Yep. So does that kind of make sense? Like our thought process changes as a market changes, right? If I'm in a market with a high interest rate where they're projected to go down, I'm probably going to take most of my clients 2-time, because I know they're going to refinance this, right? And the goal and my logic, and we even do this on purchase loans, our logic is to put the least amount of money in that loan, because we know you're not going to hold it very long, right? We don't want a bunch of sunk costs into this loan. 2-time close allow me to do that. 1-time close, if I know rates are going to go up, or they're really, really low, or you're comfortable at that, I'm going to lock you in a 1-time if I can, right? Again, we give you both of these options because we want you to know there's validity in both. And some of it just depends on the market, right? Some of it depends on what you're building, right? If you're building something that I think may have appraisal problems, I'm putting you in a 1-time if I can, so that we don't have issues twice, right? So just there's certain things that we just think about, and that's why we steer we encourage clients to go a certain way. I know steering is a bad word, so we're not going to use that. All right, so let's talk about
That was question 7 on the test, in case y'all don't remember.
So we're going to talk about process of construction lending, okay? So 1, talk to a construction lender. If you have a client that says, I may want to build my house, have them talk to us. Right? And we may have them apply, we may not have them apply, but let them have a conversation with us first, right? Because we're going to have the conversation of you need to be mentally prepared. Again, more cash, right? What does your income look like? Are we going to have issues in terms of qualification, things like that, right? Another thing that I am really big on is I'm familiar enough, and Ryan is too, with the cost of building in certain areas. I can help encourage or set expectations that, hey, maybe you should talk to a few builders before you do this, because I get a lot of people that are like, I'm going to build a barn down. It's going to be $100,000. Okay, blessings. Single wides barely cost $100,000 now, right? And so if I know that, I'm gonna have a conversation with you if their budget's not realistic, and we need to make sure that they know that, right? And I'm actually big on interviewing builders before you ever go look for lots, okay? Because it helps the client that thinks they're building something for $100,000 to talk to a builder and realize that's not realistic, right? And you're going to have one of two options. You're going to say, hey, I'm going to up my budget, or two, maybe I need to buy something that's pre-existing. Okay. Because I will tell you, like, Ryan and I have seen it multiple times. And actually, Ryan had a lot where it ended up the building cost more because of the slope of the property, that if he had talked with a builder and a builder had walked the lot with him, he may have not bought the property. Right. Yep. And so that's why I'm really, really big on, like, you as a real estate agent creating relationships with builders. And if you have a client that's interested in construction, being like, hey, I have a few builders, have a conversation with them. I'm not saying that's who you need to use, but being able to have a builder walk a lot with you is really, really important, because, like,
and showing them the survey.
Yes, because slopes are pretty. Slopes are expensive because slopes mean big foundations, right? And like, I don't,
Or crooked house.
right, or crooked house. And
I mean,
I've seen
options.
Step up.
I mean, you do some Frank Lloyd Wright stuff.
I've seen twice where a borrower fell in love with a plan that didn't match their lot, right? So let's say that I like my house to look like this, like wide ways, and the lot, my house would have to look like this, narrow ways, right? And be long this way. And I've had borrowers sell their lots because it wasn't the house that they wanted. And if they had talked to their builder before they had ever went really lot shopping
or
blueprinting, that, so I just encourage people to have a conversation with a builder, even if it's not the one you decide you're going to use, before you buy a lot. Okay. Or if they refuse to do that and they're like, we're 5 years from building, have the conversations like, just remember, you need to have someone walk this before you fall in love with a house. Okay. So talk to a construction lender, interview builders, shop for lots, work on plans and budgets. Okay. So this is the part that I will tell you, you're probably going to be the least involved in as a real estate agent, right? I don't think it's necessarily a bad thing if you have a really good relationship with your clients to let them show you the plans, because you look at houses all the time, your clients don't, right? You're going to see a door opens a really stupid way and you're going to be able to tell them that, right? But you also have to respect that the builder may be doing stuff because of, like, architecture and actual, like, function. So just be respectful of the builder and their plans and their process.
Don't pitch yourself against the builder.
Yes.
Ever. Don't side so much with your client that the builder's the bad guy, because then the entire thing goes south.
Mm-hmm.
You need to play. Yeah, you gotta keep a hand in both of those puppets there.
Yeah,
you really do.
Yeah, and some of it too is, like, figure out with the builder how involved the builder wants you to be, because some builders love working with real estate agents and being transparent, some don't. And so you want to maintain a good relationship and just see how you can be of service, right? So once your client finalizes their plans, they're going to sign a contract, and we're going to go through what the two types of contracts are, because I think it's important for you to understand to help set expectations with your client. Okay. Oh, I know. It's a hot mess. I'm a functional.
I thought you were wearing a purse sideways or something. It's
it's fine. Anyway, so once we finalize the budget and we sign a contract, that's when we come to life, right? Like your construction loan processes. You literally have to go through 1 through 5 before we can ever actually start the construction lending process. Okay. That in general takes about 37 to 45 days, sometimes 60, depending on weird nuances, right? But like your client's probably not getting a construction loan closed in 30 days. I don't care if it's with me or someone, like if it's RBFCU, blessings, gonna be 75 days. But in general, we're looking about 45-ish days. And normally we lock the loan for 45 to 60 days. Okay. Once we've closed the loan, and important for you to understand, important for your client to understand, and this is like our job to explain, down payments are due at number 6. Okay. They are not due at the end of construction. Down payments are due at number 6. Okay.
No, you know, if you were selling a house and you want to put additional funds down, you can always put more down later, but we have minimum requirements that have to be met at 6.
Okay. And we will use your client's monies first before we draw on the loan.
By the way, guys, this is their 6 steps. Okay. If you would like a copy of this, I'm sure they'll print it. I'm just saying step 6 is not an industry term. So just be careful with that. It might be with them. Like I keep hearing.
Oh yeah, we're just going by these steps right here. These are not actual step 6.
When people teach, I listen for acronyms and things like that. That might get confusing. So just real quick, guys, this is their steps. I think this is brilliant. Just let them know that whenever they want to begin the process of the loan is when they need to put their down payment down.
Yes. You're not going to be like step 6 is when you put it down and be like, huh?
Yeah.
Don't say that. Because this may be step 275th, right, with an actual builder, and I'm being a little facetious, but kind of not.
But no.
And so let's say that you have clients that already sold a house, right? Because we get those too, clients that sold a house because they, you know, maybe they capitalized on money or whatever. So let's say you're gonna put $200,000 down. I will use as a bank your $200,000 before I fund my money. And it's important for customers, A, to realize that, but 2, understand I'm not charging you interest on your money. So when you're borrowing against your own money, you're not paying anything. When you start borrowing against my money, that's when I charge you. Right? And so that's why it's really important too for clients to understand how interest only payments work. Because depending on how much money you put down, you may go 6 months into a build and not make a payment. I actually have a client right now that 7 months into their build has never made a payment because we've used their money.
But remember, once you sink it in, it's not easy. You can't get it out.
It ain't coming out. Okay.
It's a commitment. It's a year commitment.
Oh yeah. And again, the one thing I would tell you to help set expectations is like, if a client thinks they're going to spend 100,000, they're going to spend 150. Is like, make sure the clients understand that in general, construction has hidden costs that just magically emerge. Even with good builders, like even my fantastic builders, like it costs more money. So if you have clients that are very, very, very penny pinchers, maybe you talk them into new construction versus custom construction. Okay.
You know, and then they also have, you know, like change orders that you would see at new construction. So they cost money for that. You know, making changes to the property. You thought you wanted to go one way, now it's going a different way. So I always encourage people to keep money on hand.
Yes. Do not spend all your money. Do not put all your money into the loan. Like we actually talk people out of that a lot.
Whenever somebody does this, I just let them know, I'm like, this is your life for the next year.
Yeah.
It's like having a newborn baby. Like that is just what you do now.
Yes.
You deal with this house. And it's going to cost more than you think. It's going to spend more time than you think. You're going to fight about it more than you think.
Yes.
You're going to, all of that's going to happen. It sucks. Sorry. Good for you. I got 2 of them, but the whole process of building a custom home does suck. And like things like change orders, all of that stuff that they were talking about. If you've ever sold like a new construction like Lennar or, one of those kind of deals, they won't let you do change orders, right? I mean, it is an act of Congress. I mean, Greg Abbott himself has got to write a letter in order to change the tile color. You know what I mean? It's something that's stupid. But the reason why that is it's economies of scale, pre-ordering, things of that nature. And it's even more difficult when it's custom because they don't have anywhere else to put it.
Right.
So they've already ordered your tile and you decided you wanted it 2 shades lighter. You're paying for tile twice and you slowed the whole thing down.
Yep.
So that's the other thing. Just stick with the program. That'd be my other bit of advice.
Yep. So again, going through kind of the last steps, the build has begun. I think that this is where some of your value can come in, right? Is no, unless the builder provides the service, the bank is not going to do quality inspections. We do check the box inspections to make sure the work is being done. So my guys will say, yep, there's some framing there. My guys are not going to say that framing looks wonky, right? But you as a real estate professional that's helping a client could say, hey, I have an inspector. Let's walk the property together, right? Because I can tell you, I hide my redneck very well, but we built a barn apartment, right? And I didn't know what I was looking at. I do this for a living, and I was like, yep, that's a piece of wood. Cool, right? I had no idea what I was looking at.
I don't think you had that.
Yeah, that was
Sorry, go
it.
ahead.
But anyway, so working with y'all, right? Working with an inspector, and as long as you do it respectfully, most builders aren't going to be upset with you either, right? You're just all walking out to the client, because remember, homes are one of the last thing that's 100% built by hand. Like if you think about it, custom home is 100% built by hand, right? And how many times have we messed up? Your trades are going to mess up too. So
It's called a phase inspection.
yes,
It's called the phase
Usually-
inspection. You pay a little bit more and your inspector goes out every time. And I understand that, hey, the city's looking at it. If you're in the city limits, you've got permit processes you have to go through.
Yep.
Those guys are terrible. Okay. I don't mean to be rude about it, but they just absolutely are. Get somebody to check their work as well. Just
Yeah.
period, the end.
And, yeah, and then exactly. So they just phase, foundation or, framing.
it's very important to do all the stuff before the sheetrock goes up.
Yep.
That's the one thing I'll tell you is like, after that, okay, that's fine. But when it matters is when you can see it.
Yep.
Okay.
Start planning your move when the cabinets go in,
Yes, 90 days out. I tell clients.
but don't buy furniture until after you sign the papers.
Yay. Thank you.
I feel like I say that 1,000 times a day.
And you know what? They still
still
buy
do
it. And they're like, what do you mean I can't buy it?
Yeah.
Anyway. So I kind of want to run through some lending terms. And these are not specifically for construction. Some are, some aren't. Right. So let's talk equity. Okay. So I will tell you, I know I do, and I believe Ryan does it too. When we talk construction loans, I talk equity more than I talk down payment. Okay. Because when I talk construction loans, I technically need 5% equity. I don't need 5% down payment. Okay. So if you own your lot outright, that is equity. That becomes your down payment, right? So what I tell people when they're first, and this is how I explain it to your clients, right? If you bought $100,000 piece of property and you're building a $500,000 house, I will need 5% in equity or 5% down on a $600,000 build. 100 plus 500 is 600. Okay, so 5% is 600. And so we usually put it in terms like that. People are like, oh, it takes a lot more cash than I thought. Yeah. Now, go ahead.
Nothing. That's fine.
If you have a client that put 20% down on their lot, that's going to go towards my 5% requirement, right?
Typically.
Hopefully.
Yeah.
With it, as long as the appraisal holds up.
Correct. I mean, you don't want somebody putting ivory in a 1,200 square foot house, and expecting it to appraise just like anything else. So.
Yep. But just a lot of people will say, well, I have my lot as equity. Can that become my down payment? The answer is yes. On, like Ryan said, on average, right? So when I talk construction loans, and you can talk the same thing too, is like, they're going to care about your equity position. Okay. So and normally this is really good to know as a real estate agent, I would rather you put more money down on the lot and have better lot financing than to try to put the least amount down on the lot and put more down on the construction loan. Does that make sense what I'm saying? I would rather you get a better lot loan if you're going to sit on it for a while than not.
So lot loans are typically amortized over 15 years. The payments are a little bit higher. You're not paying interest only. So, if you put more money down on the lot, it helps control your payment a lot more.
Mm-hmm. And sometimes there's a break if you're putting 15 versus 20% down and things like that in terms of your interest rate and your fees. depending on the bank that you're using. So what I tell people, like, don't, let's say I have $100,000. If you sink $100,000 in your lot, like that doesn't necessarily scare me because now that's your down payment. Make sense? Now, if $100,000 with every dime that you own, don't do that. That goes back to keep money in the bank during construction. But if you have allotted $100,000 to go to something, if it goes to paying cash for a lot, cool. Now you just had your down payment is going to be your lot. Okay,
I have a question.
go for it.
So we keep talking about don't spend all your money if we go over.
Mhm.
What happens if I do spend all my money? Can I use IRA money or other funds of that nature to continue this process?
Yes,
You can, but
you're going to pay a
you,
penalty
you
on it.
may have to pay taxes and stuff like that. So, I mean, that's something that you have to take into consideration.
So there's some things, guys, make sure you talk to your people on this one. I have a little bit of information on it, but I am 95% sure that you can, if it is a first-time home purchase, you can pull that money out interest-free and be able to utilize that, or, I'm sorry, penalty-free. And if it's a 401k, they tend to charge you interest until you pay it back. So you can typically, if it's a new home purchase, you're out of a 401k or Roth, out of anything that your company hosts, you're probably gonna have to pay interest on
Be
it.
careful on that IRA though, because I had a borrower get burned from it because they needed the final CD when the house is done, and I could not provide that because it's a one-time close. And so they got burned where they had to pay taxes on it because of the nuance of, well, they need the actual CD from when the house is done, and none of us are going to be able to provide that.
I would refinance it.
I would too.
I would,
I
I would
would too.
refinance that house in 30 seconds.
Yep.
Because guys, in case you're wondering, it's roughly a 40% penalty.
yeah.
If you pull out $100,000, it's gonna cost you 40 grand if you can't get that CD. I'd rather pay y'all 10 grand to refinance the same thing.
Yep.
I would too.
But just know, like,
Start
just
over.
be careful in that.
All right, that strategy question, but
No, you're fine.
or strategy answer.
We're here for it. Ryan used this word earlier, draw. So a draw is just how a builder gets funds. Okay. Borrowers always have to approve draws. It is still their money. And that's what I tell people. You still control the purse strings. I can't just be like, here's $100,000, Mr. Builder. Borrower doesn't know. No.
Because the agreement is between us and the client for the loan. The building of the house is between the client and the builder.
And because it is a draw process, everybody, you need to make damn sure you have a reputable builder that is bonded and insured and passed all their stuff and all of that. Because a lot of them will get upside down on these builds. And then they get to a point where they can't continue construction because they don't have enough money to buy drywall. And the bank won't give you more money to give him because the drywall is not installed. So you get to this chicken or egg kind of thing if you don't have a bonded, and bonding means they've had to put money aside in case something like that happens.
Yes.
So now you can go after them. You can get that bonded. It's basically like an insurance thing. It's a pain in the ass, but you can do it. Get that money to force him to finish that construction. And then he starts paying interest. But neither here nor there. But guys, just make sure, because it is a draw process, you cannot use my cousin that happens to know how to lay tile to no.
Yes.
And if you do blessings, bad things happen.
You're gonna end up paying for the tough.
Blessings.
Is what's gonna happen.
Blessings.
And that's where that 50,000 comes in.
Yep.
Okay. Let's talk contingency. I will say we require contingency on both types of contracts.
Wait. What's a contingency?
And I would say, so a
Sorry.
contingency is a line item in a contract that is for overages. Okay. You picked a level 2 granite and mama wants to upgrade to a level 7 granite. That difference is coming from the contingency line item. Okay.
It's extra funds if needed, basically. And most of the time they're gonna tap into those extra funds. And we always encourage, it's always better to put too much into a budget as long as it appraises. So you have those funds in case anything were to happen.
Guys, the contingency comes from the Latin word, but it translates loosely into what happens if. I made that up. But
I was like,
what happens if? What happens if? What happens if? I hate those questions. And because most of them are easily answered and you just think about it for 30 seconds. But guys, that's the what happens if portion of your loan. What happens if I change my mind? What happens if I decide to sell it instead of buy it? What happens if, because that's going to cost more money, right? You got commissions and stuff to pay. Anyhow, but that's what that means, guys. Next.
Yep.
More words.
More words. Cost
I like
overruns. So basically, if you budgeted for a level 2 granite and your level 2 granite costs more, that is a cost overrun.
Ooh, awesome.
Go ahead.
Also, make sure that when you sign the contract with the general contractor, that you make sure that that bid is static. It is not flexing. Some of them will tell you, hey, look, this is how much wood costs today. Don't sign that one, because he may not try to buy wood for 6 months. And we all saw what happened whenever a truck ran out of gas somewhere. All of a sudden, wood prices quadrupled.
And we'll talk about that in a sec. Yeah.
Oh, sorry.
No, you're fine. You're good.
No,
You're good.
Do the show. It's better than me talking.
So this is where he was talking about. So there's two types of contracts. Again, there's validity in both, but you need to know how they work. All right. Fixed price contract says that you're going to pay $620,000 for your house. And if the price comes in under that, the builder gets to pocket it. If the price comes in over that, usually the builder eats it, unless you have escalation clauses on certain things. And in general, most of them do. Escalation clauses are usually going to be on your slab, your lumber, and then there's one other, but I can't think of what it is. But there's usually 3 escalation clauses in there. But this basically, like, borrower benefits if prices are going up, borrower doesn't benefit if prices going down, builder benefits, right? But you know exactly what you're getting. Okay. In this scenario, we require a 5% contingency. Okay. So that 622 number that I gave as an example included 5% as a buffer if the borrower decided to change things that changed the bottom line. Okay. Cost plus contract basically says, here's the cost of the house. Builder is getting 15% above that, or 15% of that cost. And that's the bottom line number of your house. Price go up, borrower pays more. Price goes down, borrower pays less, builder makes less. Okay. These are becoming more popular because builders are not on the hook as much, but a borrower's got to know that there's more fluctuation and they have a higher risk on this loan. Okay. We require 10% contingency. So 5 on a fix, 10 here, because in general, costs go up, costs don't go down. In general, not always, but
hooray, inflation.
Yay.
Let's just get back to 1.5%.
Okay.
Sorry.
It's fine.
That was an economics joke. It's a bad joke. But if you listen to the Fed talk, it's funny.
By the way.
Yes. Like soon.
I'm looking forward to seeing what those guys come up with. It's fun. It's just like this lottery of a shitstorm. It's like, which flag are we getting today? Frogs. Water to blood.
Why use First United? This is like real just quick stuff. We're one of the top 10 construction lenders in the state. We're actually one of the few banks that still does spec loans. So we have a really good relationship with most builders. On our construction loans, we service everything, right? Because we have a construction lending department. But even when houses are done, regardless if it's refinanced or not, we still service most of our loans. Meaning that if there's a problem, you call Ryan or I.
Basically, a few years ago, American Bank of Texas was the king of lending, construction lending, and they merged with First United back about 10 years ago, and they kind of created the construction loan, and everybody's kind of branched off because of it. So our specialty really is construction loans.
So, boom. So if you have questions, reach out to us. Okay?
Wait, I have a question. Has anybody ever done a custom build? I feel like that'd be something Melissa or Courtney would have done. Maybe Israel. You've done one, Israel? You have? Did it suck? See, I've done some, but I've never done them like to live in, or like it's the 1,200 square foot 3-2 go, right? Just build it on that lot, you know. I've done that, which it's business, so it's not quite so emotionally charged, you know.
Sorry, I'm a little sick, but yeah, I did the taking the actual builder, I don't know, assistant, whatever they call them, to go look at the lot, and we looked at all different lots, and then they went in, and then took them forever to let us know whether or not that lot was good for whatever my client wanted. But they ended up obviously taking a little bit longer than they say they would, and everything just kind of like stretched out throughout the whole process. So, but it was okay. I mean, it's not something that I would want to do all the time, but it was good.
Yeah, well, yeah. I heard if you want to test how your couples counseling's going, you should try to build a house together. But yeah. Any questions, comments, concern? Is it just me, or does that picture of Connie and Courtney, like they look like they could be sisters, right? Any questions, comments, concerns? No?
I have a question. I mean, have you guys, as far as lending on the lending side, have you guys noticed any difference lately? Any changes that have been going on with builders?
With builders or just in general?
Well, in general, I mean, anything that you've seen as far as on the new building
I'm
side.
seeing a lot more traction. I'm not
What do you mean by track?
people calling, people are interested in moving again. I'm seeing a lot more calls about building. I'm still seeing kind of a decreased contract in terms of like, hey, I want to build a custom home. People are interested in it again, but they're kind of playing this waiting game of rates going down. Most of my builders, if they're busy, are all cash. There is a ton of cash in the market.
Because nobody wants to borrow.
Would you
Yeah,
want to
We're all
borrow?
getting, everybody's getting private equity right now.
Yeah, most of the construction loans are seeing are big time money down, stuff like that.
Because all those private equity people, they're willing to take a discount on all that stuff because the they can't keep up anywhere else. So
Yep.
that's what I'm doing. But all right, well, I love y'all. Did y'all learn something? Smile and nod. Okay, good. Thank you. Matt's like, what is going on with these people? All right. Thank you. Next time, come in person. Put on the makeup, Israel. I don't think you're that sick. You'll be all right. And then
Well, I'm sick, man.
I know I've heard some stories, but
Take it easy. Take it easy.
I'm
Thank
just
you, guys.
teasing. All right,
Appreciate
guys. Y'all have a good one.